Like the weather, the stock market experiences highs and lows, sunny days as well as gloomy ones, and the forecast can change at any given time. But even in weeks when storms seem to be unceasing, we can usually count on brighter days ahead. That's why it's important to keep market corrections in perspective. That's what we're going to talk about on today's episode.
Another great episode on the show for you today. I'm Walter Storholt alongside Scott Dugan, a financial advisor that's going to help us try to make sense of what's going on in the economy right now, what's going on in the financial world, and maybe a little bit of a market correction. I've even heard the word recession thrown around a lot over the last couple of days, Scott, as we've had some market volatility. So I'm glad that you are here in times of turbulence to hopefully let us know if we should panic or if we should wait for some calmer waters here. So this will be a great time to kind of get some education and understand what's a market correction. How can we make sense out of what's happening right now?
Yeah, absolutely. And the moral of the story is don't panic. It's not time to panic.
I'm glad you didn't save that for the end of the episode.
Yeah, we don't. Yeah, it's none of the. Now, make sure you wait till the end to give you the super secret. No, let's just say no. Don't panic. We're in the early innings of a new administration, and a lot of things, going on in the media. I know we were talking before we pushed the record button. The amount of articles that use the word bloodbath and this and that. It's like, Oh my gosh. We're going to go ahead and do an episode. We're going to link a white paper that really going to distill down and go into more detail about the topic of today. But now is not the time to panic. And it's interesting the conversations that we're having, and this is probably going to be a theme for the next probably year. But depending on which side of the aisle that you're on, there are some people that aren't concerned, and hey, it's just part of the deal. And other people are saying, look, we told you so, the sky is falling. And so both ends of the spectrum, I think most people are going to be kind of right in the middle. But I get it. When you see the markets have some ups and downs and a pullback, it's natural to kind of reevaluate because we haven't had to deal with it for quite a while. And so this is normal and we'll get through this. And I think what is the catalyst to this? It's mostly we're throwing around tariffs right now, the talks of tariffs. So we're saying, hey, we're going to put tariffs on China, on Mexico, on Canada. China just put a tariff on Canada.
Back on us, so trading back and forth, barbs.
Yeah. So, and it's Trump, kind of an offhanded said, hey, is a recession off the table? He said it's a possibility. And then Lutnick came on and said, hey, that's not what he meant. But if you think about from a negotiation standpoint, and again, these are some articles that I've read since then, I think what he was saying was, yeah, we understand it could be recessionary to have tariffs. So he's continuing his posture. And this is about negotiation. And it's going to be the first country that acquiesces. And so you're seeing some of these things. Now you look at, people were very incensed about what happened at the White House, with Zelensky and Ukraine. Mm-hmm. There's a potential 30-day ceasefire that just went on the table yesterday that's been agreed upon, at least the U.S., Ukraine. Now, as of this podcast recording, I've not seen that Russia's accepted it. But you saw how quickly Ukraine came back, after the ultimatum and said, oh, hey, there's an apology. We are going to sign the mineral rights deal. And we want to move forward with peace. And so again, if we take the personality out of it, I'm just looking at what are the results? What are the results of the action, not the intent? And yes, do I wish things were more palatable, more surgical in a way? But I don't have any control over that. It's funny, they don't call me and ask me what they think they should do.
Sure.
Did they call you, Walter, and ask for your opinion?
Not yet. I did miss a few calls from unknown numbers yesterday, so maybe that was them.
That you might want to check your voice messages because that could have been it. So again, when it comes down to what people are really concerned about is, hey, is my money going to last? Going to be okay? Am I going to still be able to take a paycheck from my money? And that's where good planning comes into place. And you always want a smart place to take the money from. Yeah. And, we don't want to be in a position where you're selling your NVIDIA stock to pay your utility bill. Mm-hmm. Okay. We want to take it from cash or fixed income or things like that. And again, that's a good structured plan that we put into place for all of our clients. But we'll get into the details because I want everybody to have context of actually what is a pullback, what is a correction, what's a bull market. And I think what I want from today is to walk away with a better understanding. And so when you have dinner with friends or go to lunch, with friends, have coffee, you'll actually have data and information that's correct, not the hearsay and hyperbole that's batted around, on the mainstream media.
Okay, excellent. So yeah, I think just understanding what these things are before we actually get into the consequences of them is always really helpful. So do you want to start with, okay, if we hear the word bandied about, market correction, okay, well, what does that really define? And because I know that, and we're going to show a chart here in a few minutes as well, other vernacular, when you talk about market movement, sometimes gets misunderstood. And I know that that's going to give us some great perspective.
Oh, definitely. And when we break it down, there's basically three levels that we look at. So what's the difference? And so you've got at the highest level, a pullback, then a correction, and then a bear market. And it's all based on percentage of decline. And so right now, a 5 to 9% decrease in the market is considered a pullback. And as of this recording, I checked it right before we got on here. Example, the S&P 500 is like negative 4.65% for the year. So we're not even into pullback territory, but we're flirting with it. And now, the markets are up a little bit today. So we're not even in the first percentile of the pullback, which is 5 to 9%.
And I'm sure your timeline varies this too, right? Like if you measure it from the beginning of the year, it tells you something different than if you measure it from the very highest peak pullback. Yes. And if you measure it from 1 year ago rather than year to date, but a 12-month calendar, that would tell you a different story too.
Correct. And so once you get past that negative 9%, then you're in that correction territory, and that's 10 to 19%. And so again, pullbacks are extremely normal. They happen extremely fast. Corrections, those happen almost on an annual basis.
Okay.
And so, 10 to 19% is not uncommon. But a bear market is when you're that 20% or more. And that's when people get nervous.
Yeah.
And if you look at, 2023 and then the start of COVID, and then you go back to 08, 09, 01, 02, 03, that's where you saw bear market, recessionary issues. But again, right now we're in the early stages of what we call pullback. And depending on what happens and what transpires from a negotiation standpoint about tariffs, we could erase those quickly, or it could continue. Nobody has a crystal ball, and anyone that tells you they do, I would be leery of them because they don't necessarily have that superpower to be able to predict the markets. And so again, that is the differences of a pullback, correction, and a bear market. And right now we're barely in the pullback phase if you base it on year to date, in 2025.
Okay. If folks are worried that this is, going to turn into a market correction, then how can we steer the conversation for folks to either have better insight or to be helped by additional knowledge? Are we looking at, do we want to define kind of the factors that go into creating that market correction?
Oh, absolutely. Yeah, we'll definitely can cover those.
Okay.
And again, before we get into those, I will say that most of the time, if people are deriving a paycheck from their investment plan, their retirement plan, these corrections are going to be normal. But we always have backup plans. We always have cash available. Most of our clients, we have 90 to 120 days of cash. If we've got a monthly deposit of $5,000, there's $15,000 or $20,000 sitting in a money market account, earning a little over 4%, and that's ready to be deployed. And then behind that, there's a war chest of capital preservation, conservative investments, fixed income. That could be certain types of annuities where there's a safe place to take the money from beyond that. And then we've got midterm, and then we've got long-term money. So we've got different buckets to pull from. So again, we're not panicking. We're not buying high and selling low, because you definitely don't want to do that. And so again, having a good investment discipline in your plan is paramount with this.
Well, I know that you mentioned that the tariffs have certainly been part of the big triggering of the pullback and perhaps of a correction if we head into that territory for some reason. But that's like most things in the financial world. It's not, a black and white kind of thing. There are other factors that go into it, right?
Oh, absolutely. Absolutely. So you're correct, Walter. I think tariffs are, pushing this. There's some knee-jerk reactions. There's other things that can trigger it. Profit selling. Investors may choose to sell their stock, to realize some, profits. So that could happen. Could be technical
Seems like with
analysis.
us being so close to tax time too, that's kind of that might actually be playing a bit of a factor in this as people
That
take some profits before tax.
Yeah, could be possible.
Yeah.
We execute a lot of those things obviously prior to the end of the year to lock
Okay.
those in. But there could be some people that are doing that. Let's see, technical analysis can come into play there. When analysis indicates that a group of stocks or the market as a whole is in a pattern, then it could be a trigger to sell things off if you've got algorithmic trading that triggers that. Corporate earnings. It could be corporate earnings are missed or way off base. And then the final one I think is playing in right now is just fear.
Yeah.
And if there's a broad sense of fear of the unknown, then that's where people can follow the herd and get stampeded into making bad decisions or triggering people to sell off. And so again, that can really build on itself, and people get herded into the wrong direction. And so again, I think where we are today, it's not in a catastrophic situation. Now, obviously, we're watching this on a daily basis, but it's not causing us to make big knee-jerk reactions.
Yeah.
Because ultimately, the things that are being attempted are in, their belief is that they're making changes that may be painful, may be volatile, but maybe strengthen things going forward. And again, that's not a political statement. I'm just telling you that's what the administration that's in power, they have a strong belief in what they're doing, but it's the outcome that they're looking for. And again, we're going to reserve judgment until we have results, and either they're going to be positive or negative. And we'll judge those results at that time. Because I think if everyone could spend a little more time doing that, I think things would be a little calmer, and not everybody would be so on edge.
Is your retirement strategy working as hard as you are? Get the answers you deserve with Elevated Retirement Group's information-packed toolkit. Inside, you'll get Scott's book, Exceptional Retirement, along with essential insights covering the 5 key areas of retirement planning, strategies to keep more of your hard-earned money, and how to choose your winning retirement team. Take control of your retirement today. Click the link in today's show description to claim your toolkit at no cost to you.
Yeah. I know the question everybody's probably got on their minds is, okay, well, market corrections are one thing, but how does it impact me? We always circle it back that way anyhow, because you're always putting together individualized plans for people, Scott. So when we look at it from a more individual basis, what do people need to be aware of when it comes time for a market correction, again, if we head into that territory?
And again, I would start to say, with our clients, they all have a risk number. And that's kind of our speed limit sign of what you're able to tolerate, the ups and the downs. We put those guardrails in place. And I can tell you if we're down, not even 5% for the year, that's well within the guardrails. That's normal stuff. So if we decided ahead of time that we're okay with a range of movement in the value of our portfolio, if we're operating within that range, then there isn't a problem. Now, if it's causing you issues, then we've got to revisit the number. We've got to figure out, are those guardrails appropriate? And so again, it's what's your personal risk profile? What's your risk number? Are you comfortable with that? And we've had people say, oh my gosh, you must be getting tons of calls. No, fortunately, we are not. We've had a few emails that come through. We've had a few client calls, but no one's panicking. They just needed to be reassured. And we talked them through the reality, the numbers of what's going on. and everyone's fine.
These types of events were discussed in the planning process.
Yes. Yeah. You can expect in a 6 to 12 month period, the money that's in the market's going to operate in this range.
Yep.
And we're well within those ranges. Yeah. So again, for most people, we've got things set up that your plan is going to work if the markets overproduce. They're going to work if they underproduce, or if they go sideways. We've got plans for our clients to make sure that we have a stable, predictable place to take money from.
Well, you talk about sideways. I mean, I think that brings up another important element to this that I know you talk to folks about, is that risk conversation is not just about the guardrails of amount up or down this much, but a time component to that. A downturn with a quick upturn is a lot different than a downturn and then 2 years of sideways movement.
Right.
And so that's good to keep that in mind.
Oh, definitely. Because if you've got I started my career in 2001. Well, 2010 was called the lost decade.
Yeah.
Because the S&P did this, and after 10 years ended up where it started. So that's a rough time to be retired.
Yeah, even like 08 and the COVID, downturn and return, those were very different, right? I mean, maybe 08 took a little while, but certainly not as long as that 2000 decade.
Yeah, 08, it started in 08, March of 09, we got our trough, but back it took about 3.5, 4 years to get back. So lost decade, and then we had 3.5, 4 years in 08. COVID was 4 months with massive government intervention, but that was a that was a reaction, and we knew that things were getting shut down.
Yeah.
Now we're seeing
a self-inflicted wound rather than just forces happening.
Yes. Yeah. And we're seeing the repercussions of that play itself out, where interest rates, where they got up to, now they're trying to control interest rates. And part of this, possibility in the negotiations, the Fed talked about, hey, well, I read an article yesterday. Could we see a Fed rate decrease of 0.75%, by the end of the year? And that's kind of contrary to what they talked about before.
Yeah.
But lower interest rates, if you think about it in the broad terms of our debt, there's debt that we have to refinance. And if interest rates are lower, they're going to refinance at a lower rate. So I can't say that there's a strategy around that, but that's definitely an impact potentially.
Another factor at play.
It is. Yeah. It's above my pay grade about those decisions. But back to, what does it mean for you personally? You the investor. If you're uncomfortable, then that warrants a conversation, with whoever you're working with, and double checking what your risk number is, your risk tolerance, and making sure and your investments match up with that. And then you need to talk about if you're uncomfortable, what are your options at that point? And again, I would caution you to make emotional, irrational decisions based on, the whims of the day. That's not a good way to make decisions.
Yeah, good points. All right, so let's give folks, Scott, as a way to wrap up today's episode, 5 actionable items or things that they can do in a market correction, or even if we don't hit that territory and we just stay in pullback territory. I think these would still be 5 wise things to do during a time like this.
Yeah. So number 1, be patient. Just like anything else, the speed at which things drop and rebound is extremely fast right now. And so again, we're not on a downward trend, a prolonged one. So I said, be patient, see what happens. Don't overthink it. And that's the other thing. These are regular occurrences. It's part of a normal market. And so I would tell you, turn off the TV. And again, just checking the markets before I came in here, all the clickbait ads below it and articles were just ridiculous.
Yeah.
So you would think the sky is falling and you should put all of your money into gold. That's kind of what the marketers are telling you.
Yeah. They've got those ads dialed in. Perfect.
They're ready to deploy.
Like yeah.
The other one is fight your instincts. The reason people get rewarded for long-term exposure to the market, it's being in the market, and you're rewarded for longevity in it. And so again, if you're fighting that, oh my gosh, we've got to do something. This time it's different. This time it's different. Well, it's not.
Or if you feel that fight or flight instinct coming into play,
Yeah.
you're wanting to fight that when it comes to investing.
Yeah. So again, hopefully you're working with someone that you can have an honest, candid discussion with. And again, one of the emails I responded to yesterday, longtime client, she's recently retired, and very nice email. She goes, "Hey, I know we're coming to see you for our planning meeting in about a month, and we're never one to be concerned. But I'm retired now and I have an income, and I'm a little freaked out. And can we just talk? And can we just kind of walk through it?" And I sent an email. I kind of laid everything out. I said, "Hey, here's my thoughts. And if you want it, let's hop on a call if you want to. But here are my thoughts about the situation." And it came back, said, "Thank you for responding and talking me off the ledge. I'm good. And we'll talk to you later." So again, sometimes it's just putting it out there and hearing back from someone that you trust, your trusted advisor, to say, "Hey, it's going to be okay."
Or just being reminded of what you already know.
Yes.
Yeah.
Absolutely. And then, so then stay diversified. That's it. You want a lot of eggs in a lot of different baskets and a lot of different people watching those baskets. Okay.
Yep.
And the final thing is working with an advisor to constantly look at your situation. And there's going to be times where you need to make changes, and there's times you're going to feel like you need to make changes, but you shouldn't. And that's the thing with a good advisor. He or she will be non-emotional about the money, because as if it's our money, we become very emotional about it. And so a lot of the things that our time is spent really counseling our clients to make good decisions that are in their best interest, and to fight against all those natural instincts that can derail your retirement. That's what you're paying an advisor for. Yes, they help pick your investments and reduce taxes and talk about healthcare, but ultimately keeping you between the guardrails and not becoming too emotional and making, again, irrational decisions that can derail your retirement. That's what a good advisor can do in times like this.
Well, if you're struggling through a time like this, if the market bounce down has given you heart palpitations or just made you nervous or lose sleep, those are realistic signs that maybe something's misaligned in your portfolio. Maybe you need a more solid financial plan in place. And if that's the case, you can always reach out to Scott Dugan and the team at Elevated Retirement Group. They're going to help walk you through what your current plan looks like, what your current situation is, and start mapping out where you want to be. And all right, how are we going to connect those dots? How are we going to get there? How are you going to live with this plan and be comfortable during times of uncertainty, during times of tumultuous volatility in the market, kind of like we've experienced over the last couple of weeks and even the last few days if you're watching this shortly after this video has been released or this podcast has been published. So if you find yourself going through things like that, don't hesitate to reach out and schedule a time to meet with Scott. We've got contact information on the screen for those of you watching. If you're listening or you just want to check it out after the episode, just look in the description, and we've got links to schedule a time on Scott's calendar. You can schedule from your smartphone or computer very easily there, and we've got the phone number, website, and other ways to get in touch there as well. Scott, thanks for all the help and navigating us through some of these market correction conversations, and I'm sure it won't be the last time we talk about volatility this year. Probably might come up again.
I can almost guarantee you that for sure.
Thank you, my friend. We'll see you next time, and thanks everybody for joining us. See you soon.
Are you on the path to retirement but feel uncertain about your direction? Don't let myths and misconceptions cloud your journey. Before stepping into a lengthy retirement, gain clarity and confidence with a complimentary financial review. Schedule a conversation with Scott Dugan. It's completely free. Just click the link in the description below or call us at 913-393-4724. Let's start a conversation about what's most important to you as you plan for a successful retirement.
This video has been prepared for educational and marketing purposes only. The information in this video is general in nature, does not constitute personalized investment advice, and does not provide a complete analysis of the subjects discussed. All investments involve risk, and different types of investments involve varying degrees of risk. There can be no assurance that any specific investment strategy will be profitable or suitable to you. Additionally, although information presented in this video is believed to be factual and up to date, we do not guarantee its accuracy. You should consult an attorney or tax professional regarding your specific legal or tax situation and should consult a professional advisor before implementing any of the strategies mentioned in this video. Investment advisory services are offered through Elevated Capital Advisors LLC, an SEC-registered investment advisor affiliated with Elevated Retirement Group LLC. Registration as an investment advisor does not constitute an endorsement of Elevated Capital Advisors LLC by securities regulators, nor does it indicate that the firm has attained a particular level of skill or ability. Insurance advice and products may be offered by a third-party insurance producer, which may be affiliated with Elevated Retirement Group LLC and Elevated Capital Advisors LLC. Walter Storholt and Third Wheel Media LLC receive compensation for their assistance in preparing and hosting this video.